Welcome to our reading on non-current liabilities. Our first LOS asks us to determine the initial recognition and measurement and subsequent measurement for bonds. So in other words, what do they go into the balance sheet when the bond is first issued? Then as the bond ages, how does the balance sheet value change? Okay, before we get into that, let's have a little look at some terminology. Par value of the bond, of course, is the face value of the bond and the amount that the bondholder receives at maturity. Typically, we'll assume $1,000 par value for US bonds, but of course they can be traded in amounts that are greater than this. The coupon rate is a fixed percentage of the par value, and it's always quoted annually, even if the bond, of course, pays semi-annually. The initial liability. Now, the initial liability is going to rather depend on whether we're looking at US GAAP or IFRS. Let's take the US GAAP treatment first. It's simply the issue price, i.e. the proceeds the company receives when they issue the bond. And what would that equal? Well, it would be the present value of the future cash flows, i.e. coupon and principal payment, discounted at the market rate of interest, i.e. the investor's required rate of return, when the bond is issued. Now, I said IFRS is subtly different. It is, because what we do is we take the issue price minus any costs of issuance. So you're going to get a smaller liability figure under IFRS than you will do under US GAAP. Okay, on to the effective interest rate. And again, this is going to differ between IFRS and US GAAP. The effective interest rate is the discount rate that equates the present value of the future cash flows with the issue price. Well, that's true of US GAAP. So in other words, it's the market rate of interest at issuance with US GAAP. Now, under IFRS, it's going to be subtly different. Because remember, we take the issue price minus any issue costs. So therefore, it's going to be the discount rate that makes the net issue price minus issue costs, equal to the present value of the future cash flows. So again, you're going to have a higher internal rate of return because you've got a lower present value, if you like, under the IFRS approach. Now, the interest expense is going to be the same under both methods. It's always the opening liability value times the effective interest rate that you computed when the bond was first issued. So let's have a little look at the impacts on our financial statements. When we issue a bond, we're going to create a liability equal to the proceeds received under US GAAP. But of course, remember, IFRS, the liability is equal to the proceeds received less any issuance costs. On the income statement, the interest expense will be the opening liability value times the market rate at the time of issuance. Again, true under US GAAP. I would rather you learn that it's the opening liability value each period times the effective interest rate. Now remember, the effective interest rate would be the market rate for US GAAP, but the effective interest rate is likely to be higher under IFRS if issuance costs are included. Now, of course, we also have impacts on our cash flow statement. CFO each period is going to be reduced by the coupon that's paid out on the bond. CFF is going to increase when the bond is issued by the proceeds received, and CFF is going to decrease at maturity by the principal that is paid out. Now, we're going to look at bonds in three scenarios. A bond issued essentially at par, a bond issued at a premium, and a bond issued at a discount. Let's take our first scenario here. What if the market rate equals the coupon rate? Well, of course, in fixed income, we see that if the investor's required return is equal to the coupon rate, then automatically the bond will trade at par. Why? Because the investor doesn't need to make any capital gain or capital loss. The coupon is enough to satisfy them. So notice, therefore, the initial liability is equal to the issue price, which is equal to face value. In other words, the par value of the bond is the initial liability. Now, the liability will remain at its face value over its life, over the bond's term. And we've said there's no amortization required. Now, we're going to see amortization in just a while when we start to look at bonds that are issued at premiums or discounts. Because a bond that is issued at par has no premium or discount, there is no discount or premium to amortize, so we will not see amortization. And of course, the face value, the par value, is paid at maturity. In the income statement, of course, the interest expense will be the opening liability, which will be par value and will remain at par value over the bond's life, times the market rate when the bond was issued. Now, of course, because market rate and coupon rate are the same, it means the interest expense for a bond that is issued at par will equal the coupon payment. This will not be the case when we look at bonds issued at discounts and premiums. So let's have a look at a bond issued at a discount. Well, this is, of course, when the market rate is greater than the coupon rate. In other words, the coupon is insufficient to meet the investor's required return. So they're going to need to buy the bond at a discount. It will redeem at par $1,000, making them a profit, giving them the capital gain to top their returns up. So the initial liability that we're going to see in our balance sheet will be the issue price. And of course, the bond is issued at a discount, which means this will be less than par value. Now, the key here is our liability will increase over time as we amortize the discount. What you've got to think here is what we're going to try and do is increase the liability over the bond's life so that at maturity, the liability sits at par. So when the bond is redeemed, we pay out the par value, we eliminate the liability that's sitting at par, and we have no gain or loss. So bonds issued at a discount, the liability value will increase over time as we amortize that discount. Okay, yes, the balance sheet value is equal to the present value of the remaining cash flows discounted at your original interest rate, market rate, when the bond was issued. And of course, we know as well that at the bond's maturity, the par value will be repaid. In the income statement, now here's a key point. The interest expense is not simply going to be the coupon here. In fact, our interest expense is made up of coupon plus the amortized discount. Now we can calculate the interest expense by taking the opening liability value for each period times the market rate when the bond was first issued. Now what we're going to notice is that the interest expense will increase over time with a bond issued at a discount. Now again, think about it. The book value, the liability value, is increasing as we amortize the discount. Given that our interest is opening liability times market rate at issuance, as the liability value increases, the interest expense, is going to increase. Our final scenario is a bond issued at a premium. Now this, of course, is because the coupon rate is greater than the market rate. In other words, investors are receiving too high a coupon given their required return. So we need to take some return away from them, so we need to give them a capital loss. So in other words, they buy the bond at a premium, but it redeems at par, giving them their capital loss and bringing their returns down. Again, the liability in the balance sheet is going to be equal to the issue price. Now again, in these scenarios, we're kind of ignoring the issue of issuance costs under IFRS, but we will discuss those later. So the initial liability will equal the issuance price, which by definition, because the bond is at a premium, will be higher than par value. Now the trick with a bond issued at a premium is we're going to reduce that liability value down over time so that at maturity of the bond, it's sitting there at par value. So when we redeem the bond, there's no gain or loss. The book value, yes, is still equal to the present value of remaining cash flows. And of course, at maturity, the investor receives the par value. Now, the interest expense is computed exactly the same way. Opening liability times market rate at issuance. Now, what we're actually going to notice here, that when we amortize a premium, the interest expense is equal to the coupon minus the amortized premium. But we can compute it as opening liability for the period times the market rate at issuance. Now the interest expense is going to decrease over time. Why? Because as we amortize the premium, the liability value in the balance sheet decreases. So our book value is falling, so book value times market rate at issuance is going to give us a lower interest expense as the bond matures. Now, there are actually two ways of dealing with amortization. One is known as the effective interest rate. In other words, what you do is you compute the internal rate of return when the bond is issued. Okay, and that internal rate of return, the market interest rate, is used essentially to compute the coupons and the amortization. So notice the interest expense is the yield to maturity at issuance, the IRR on the bond that compares the issue proceeds with the future cash flows. So it's the yield to maturity times the opening balance sheet liability, and that gives us our interest expense. The difference between the coupon that's paid and the interest expense is the amortization of the premium or discount. Now note, of course, as we said, with a bond issued at par, the coupon will equal the interest expense, so there is no amortization. With a bond issued at a discount, the interest expense will be greater than the coupon because of the amortization. But with a bond issued at a premium, the reverse is true. The interest expense will be less than the coupon. The amortized premium, in other words, reduces the interest expense. Notice the effective interest rate method, i.e. the internal rate of return approach that we're using here, is required under IFRS, but only preferred under US GAAP. US GAAP again gives you a nice kind of shortcut calculation that you can do. Rather than amortizing according to an effective interest rate, we can do straight line amortization. In other words, charge the same amount of amortization of premium or discount for every year of the bond's life. Again, the interest expense will still be coupon plus any amortized discount minus any amortized premium. Okay, and that of course is permitted under US GAAP. Okay, now it does ask us to not only discuss the effective interest rate method, but also calculate. So we're going to have a look at it now with a little example. So we've got Leeds Corporation here issuing a 3-year $1,000 par value bond with an annual coupon of 10% at 951.96. The market rate is 12%. Now, of course, we could compute that market rate just to check it. If you use the time value money buttons on your calculator, you could type 3 is N, 1,000 equals the future value. We've got a coupon of 10%, so 100 equals payment. Enter the present value as 951.96 negative, present value, and compute IY, and you can see we get 12%. Okay, in other words, the market rate of interest at the time of issuance is nothing more than the yield to maturity on the bond. Now note we are assuming an annual pay bond for this example. So when the bond is issued, two things happen. Up goes cash by 951.96 and we record a liability in our balance sheet 951.96. The interest expense in the first period in year 1 is the opening liability 951.96. So if you do 951.96 times the yield when the bond was issued, the market rate of interest, so times 12%, and you get 114.24. Now compare that to the coupon paid that passes through the cash flow statement. The interest paid in the cash flow statement is only $100, the coupon. The difference between the interest expense in the income statement and the coupon paid is the amortized discount. So our amortized discount in year 1 is 14.24. Now that amortized discount has increased the interest expense. It also increases the balance sheet liability. So the balance sheet liability at the end of year 1, beginning of year 2, is now 966.20. Year 2's interest expense is then computed as 12% of 966.20, giving us 115.94. Compare that to the coupon paid, $100, and we've got amortization of 15.94. Again, that 15.94 has increased the interest expense, and it also increases the liability. So the liability at the end of year 2, beginning of year 3, is now 982.14. Take 12% of 982.14 and you get the interest expense for year 3, 117.86. Compared to the coupon, 100, and we've got amortization of 17.86. Okay, and again, that amortization is added to the liability, so the bond liability at the end of year 3 is equal to $1,000. The bond redeems for $1,000. We extinguish the liability of $1,000. No gain, no loss. Now, what I will point out here as well is you can do this on the BA2 Plus calculator. If you look above the present value button, you'll see a button called Amort for amortization. Now, if you enter the bond, N equals 3, future value equals 1,000, payment equals 100, present value equals 951.96, and compute your IY and get 12, You've got everything in there. Then press second function and the amortization button. When you do that, you'll notice P appearing on your screen. So it's asking us, what period do we want to know from the beginning of? Let's say we want to know year 2. So I'm going to change P1 equals 2. So from the beginning of year 2, press the down arrow, and you'll see P2 appear. This is to the end of the period. So if I want year 2, I would also want 2. So I'm saying P1 from the beginning of year 2 to P2, the end of year 2. If you were dealing with a semi-annual bond, for example, then for year 2, P1 would be 3 from the start of the third 6 months, and P2 would be 4 to the end of the fourth lot of 6 months. So that it would change. P1 and P2 would not be the same for a semi-annual bond because you're dealing with 6 monthly periods. Here we're dealing with annual, so P1 and P2 will be the same. So I've entered P1 is 2, P2 is 2 for the second year. I can then press my down arrow and it tells me balance. And I've got 982.14 appearing on my screen. And that's the liability value at the end of the second year, beginning of the third year. Press down arrow again and 1594 appears. So that is the amortization that I've got on this bond in the second period. Down arrow again, interest 11594. So my calculator tells me the interest expense that's going through the income statement. If I want year 3, P1 equals 3, P2 equals 3, and again by using the up and down arrows I can see the data there. So a useful little shortcut to know in the exam. Notice here is a straight line approach which is allowed under US GAAP but not IFRS. So notice all we're doing is taking the discount, and of course the discount to par is $1,000 par value minus our bond proceeds 951.96, 4804, and then we're saying okay, we've got 3 years, so divide that by 3 and we've got 1601. And all we're doing therefore is amortizing 1601 each period. So notice the interest expense as before is coupon plus the amortized discount. So notice therefore that all we're doing, whether we're doing an effective rate or this straight line amortization, is that the total interest expense is made up of the total coupon over the life of the bond plus the discount over the life of the bond. Let's have a look at a zero coupon bond, because this does raise the idea that even though there is no coupon on a zero coupon bond, we'll still see interest in the income statement. Why? Well, because by default, zero coupon bonds are issued at a discount, and therefore we're going to spread that discount over the life of the bond. So let's have a look at our example. Vine Corporation has got a 3-year zero coupon bond, ZCB, par value of $1,000, and they've issued for $711.78 with the market rate of 12. Okay, again, you could compute that market rate if you want. $1,000 is your future value. 711.78 negative is your present value. 3 is N. Leave payment as 0. Compute IY, and you get 12. Now notice then the way we compute the interest expense is exactly the same. Take the opening liability, 711.78, times the market rate at the time of issuance, 12%, to get 851.41. Compare that to the coupon. Well, of course, it's a zero coupon bond. There is no coupon. And therefore, the interest expense is purely made up of the amortized discount. Again, if you want to get the interest expense and amortization, you can do it using that amortization function. So second function, amortization, I'm going to do P1 equals 1, enter, P2 equals 1, enter, and I can see at the end of the year, end of year 1, beginning of year 2, my liability is 797.19. The principal element, which is the interest expense, is 85.41. And sorry, the principal is the amortization, 85.41, and the interest, 85.41. Okay, so you can do it on the calculator. So remember, with the discount, it increases the interest expense, coupon plus discount amortization is the interest expense. So 0 plus 85.41 gives you your interest rate expense. That 85.41 is added to the liability at the end of year 1, beginning of year 2, to give us 797.19. 12% of that, 95.66, is our interest expense in our income statement, and the full amount is made up of amortization because the coupon is 0. So therefore the liability climbs by 95.66 to be 892.85 at the end of year 2, beginning of year 3. 12% of that, 107.14. All of that, of course, is amortization. Add that to your opening liability to get the bonds redemption of $1,000. Okay, we've got a tiny rounding difference of 1 cent, but you see how this works. So notice that bonds that are issued at a discount, and a ZCB being a classic example of that, you can see that the interest expense climbs over the life of the bond as the liability value increases. You'll also notice that with a 0 coupon bond, the total interest expense over the life of the bond, 851.41 plus 95.66 plus 107.14, is simply equal to the discount the bond was issued at. So 1,000 minus 711.78. Our bond was issued at a discount of $288.22, which is the interest expense here. Okay, in other words, the amortization just takes the discount and spreads it. So let's have a look at a premium bond. Treatment is exactly the same. The only difference here is the amortization works in the other way. In other words, rather than increasing the liability and increasing interest expense, it reduces the liability and reduces the interest expense. So let's have a little look at our question here. We've got a 3-year $1,000 par value bond. So 1,000 equals future value. 3 equals N. It's got a coupon of 20%, so 200 is payment. And we issued it for 1130.88. So 1130.88 negative present value. Compute your IY, and you get your effective interest rate of 14.33. Now again, if you didn't want to do the numbers numerically, you could manually, you could use the calculator by using second function and amortization, remember. So notice when the bond is issued, up goes cash by 1,130.88, and of course we record a liability at 1130.88. The interest expense is of course 14.33% of that opening liability, giving us 162.06. Notice this time it's way lower than the coupon. In fact, 37.94 is the amortization of the premium. This has reduced the interest expense in the income statement, and it reduces the liability in our balance sheet. So at the end of year 1, beginning of year 2, our liability is now 1,092.94. 14.33% of that, 156.62. Again, it's lower than the coupon paid, the difference being the amortization, 43.38. And of course, deducted from the liability to give us a liability at the end of year 2, beginning of year 3, 1,049.56. 14.33% of that, 150.40, compared to the coupon of 200, gives us amortization of negative 49.60. Okay, reduce the liability by 49.60, and the bond is now at par. Again, the small rounding difference of 4 cents is due to rounding errors in this particular example. Okay, so notice what we see here is that the interest expense is lower than the coupon paid. In fact, the interest expense is lower than the coupon paid by $130.88, which is the premium that we received when the bond was issued. So again, all that's happening is this premium is being spread over the life of the bond, and it's reducing the interest expense in the income statement. The coupon paid, of course, remember, goes to CFO. The interest expense is in our income statement. Straight line, well, again, you can look at this in your own time. All it's done is taken the 130.88, which is the premium, divided it by 3 years to get a straight line, a smooth amortization of a premium of 43.63 each period. And again, remember, that's being deducted from the coupon to get interest expense each period, being deducted from the liability to get the closing liability each period. So notice that our interest expense essentially would be roughly very smooth under this approach, whereas under the effective interest rate, of course, notice that your interest expense for a premium bond would decrease over time. Why would it decrease? Because, of course, it's based on the opening liability value. So let's talk about issuance costs. We briefly mentioned these right at the start of our study set, of our reading here. Issuance costs is treated rather differently under IFRS and US GAAP. So what are issuance costs? All of the costs of issuing your bonds, so legal fees, underwriting, printing of prospectuses, commissions to brokers, etc. Under IFRS, all the costs of issuing the bond are deducted from the bond's liability. In other words, the initial liability that we face in our balance sheet is the proceeds received minus the issuance cost, giving us a lower liability value. Now, of course, if we have a lower liability value, when we compute the effective interest rate, which is just an internal rate of return, because our present value is lower and the future cash flows are unaffected, then by definition, you've got to have a higher effective interest rate. Now, the US GAAP treatment is completely different. Issuance costs are not deducted from proceeds. In other words, the opening liability will always equal the proceeds received. Instead, the issuance costs are going to be shown as a prepaid expense, a deferred charge. They're going to sit in it essentially as an asset. Now, it is pretty controversial, this treatment, because it isn't really meeting the definition of an asset. Remember, an asset leads to future inflows of benefit. Now, if you've paid issuance costs in the past, where's the future inflow of benefit from that? You've paid it, it's sunk. Now, all they're then going to do is take this prepaid asset and essentially amortize it over the bond's life. Okay, so let's have a look at a bond issuance question. So, Acme here issues an 8% coupon 10-year annual pay bond when the market yield is 7.5 for $1,034.32. First of all, of course, you can see that the yield is below the coupon rate, so it makes sense that this bond trades at a premium. Now, straight away, of course, what I should be thinking is, look, if it's trading at a premium, the interest expense will be lower than the coupon. Why? Because we're going to be amortizing a premium. So given that the coupon would be $80, then I know that the interest expense has to be lower than that. So A can't be right. Now, that gives me a choice of B or C. So I'm going to assume 7757 is correct because both B and C say that. In fact, I could compute that as 7.5% of the initial liability, 103,432, and I'd get 7757. Now, B says 7757 and net income is more than with equal proceeds from par debt. Now, let's just break down what that means, equal proceeds. So it's talking about me issuing a bond with a par value of 1,034.32 and a coupon rate of 7.5%. That way, I would receive in 103.34.32 when I issued the bond. Now, in which case, the coupon would be 7.5% of that par value, 1,034.32. It would also be 77.57, which means net income would be the same. So B can't be right. So our answer has to be C. And indeed it is. Okay, let's have a look at the effect of changing interest rates. Now, the key point to note here is we do not see the fair value of the bond in the balance sheet. What we're seeing in our balance sheet as carrying value is amortized cost, or if you like, the proceeds minus the amortization of any discount, minus amortization of premium, or plus the amortization of a discount. Now, first bullet point talks about the inverse relationship between market values and interest rates. Well, we know from fixed income that as interest rates go up, yields go up, and as yields go up, then bond prices come down. In other words, yield is the discount rate that we use to compute the present value, and present value is price. So as interest rates go up, the present value of the future cash flows fall, and bond prices drop. Now, our second bullet point is just stressing the fact that when we look at the balance sheet, the carrying values we see are not the fair values of the debt. They're not the market values. As a result, when interest rates change, it does not affect the balance sheet or the income statement, because the carrying value, remember, is the initial proceeds minus any amortized discount, or the initial proceeds, let me start that again. The initial proceeds plus any amortized discount, or the initial proceeds minus any amortized premium. Which means, therefore, that carrying value does not equal fair value when interest rates change. Remember that the effective interest rate that we use when computing amortization is the interest rate at time of issuance. Subsequent changes to interest rates do not affect the carrying value. Now, the one exception to this is liabilities hedged with derivatives, i.e. fair value hedges. Remember what we said is when you have derivatives, you'll mark those to market, and any asset or liability they're hedging will also be marked to market. It makes sense because essentially any gain or loss on the derivative should be offset by a gain or loss on the liability that it's being used to hedge. So for analysis, market value would be more relevant than book value. In other words, if we're an analyst, we don't really care about amortized cost. What we're interested essentially in is the true fair value of the bond. Why? Because that would represent the cost of the company of going into the market and actually buying back the debt and cancelling it. You would have to pay the current price of the bond. Lower market values, therefore, reflect stronger solvency positions. Why? Because it's cheaper to buy back the debt and cancel it. Now notice both US GAAP and IFRS do give firms irrevocable, that's the word, irrevocable option to report debt at fair value. In other words, you can choose, rather than using the effective interest rate solution and using proceeds plus amortized discount or minus amortized premium, instead you can elect to record at fair value. Once you choose to do that, of course, you can't change. You can't chop and change between the two. You would have to use fair value going forward. Okay, so we move on to debt extinguishment, and it asks us to discuss derecognition of bonds. Now, of course, at maturity, there is no impact on the income statement when bonds reach maturity. Why? Because under our method, the bond's value in the balance sheet, the liability value would be $1,000 par value, and of course we'd pay $1,000 to redeem it, giving us no gain, no loss. In other words, the carrying value is equal to the redemption value at maturity, no gain, no loss. But what about bonds that are extinguished prior to their maturity date? Well, then we might see a gain or loss. Now, what we need to do is compare the balance sheet carrying value to the repurchase price. And put simply, if the company has to pay more than the balance sheet liability value, you're going to get a loss. If the company pays less than the balance sheet liability value, you're going to get a gain. Now, that's the end of story with IFRS. With US GAAP, we've got a little further step to take. Because remember, if there are any issuance costs, they're treated as a separate asset in the balance sheet, which is being amortized. So, of course, if we extinguish our debt by buying it back, we no longer need that asset, so that asset has to be written off through the income statement. So we take the balance sheet carrying value minus the repurchase price, giving us our gain or loss, then deduct any unamortized issuance costs at the point of retirement to get overall the gain or loss under US GAAP. Remember, you'll see that under US GAAP, but not under IFRS. Remember, under IFRS, the issuance costs are deducted from proceeds when you establish your effective interest rate. So again, basic rule, if you pay more than the carrying value, you're going to get a loss when you retire your debt. When you pay less than the carrying value of the liability, you're going to get a gain. And of course, it should be discussed both in the management discussion and analysis and the footnotes. Excellent. Our next LOS asks us to explain the purpose of covenants. Now, of course, covenants are all there to protect the borrower, i.e. the bondholder in this case. To protect the lender, I should say, from the borrower, i.e. the bondholder. So these are restrictions placed on the borrower, the company, to protect the lender, the investor. Now, of course, if we violate a covenant, then we discuss the bond being in technical default. And often what that means is the lender, i.e. the investor, can demand full payment, or at least be able to renegotiate the terms of the bond and normally ask for a higher rate. So we talk about both affirmative covenants and negative covenants. Affirmative covenants, the borrower is agreeing to do something, and negative covenant, the borrower is agreeing not to do something. So affirmative covenants will include making timely payment of interest and principal, maintaining ratios above certain levels, such as the current ratio, debt to equity, interest coverage, maintaining any collateral if collateral is supporting the loan, and paying taxes on time. Negative covenants prevent the borrower doing something, such as paying dividends or repurchasing shares, entering mergers and acquisitions, or issuing more debt that is more senior to the existing bondholders. We also need to discuss the disclosures for long-term debt. So notice the balance sheet split will give us the split between current liabilities and long-term liabilities. Any payment falling due within the next operating cycle, or 12 months, whichever is the longer, will be in current liabilities. Any payments falling due after more than 12 months will be in long-term liabilities. The footnotes will give the nature of the liability, i.e. the type of the bond. It will state maturity dates. It will give both stated and effective interest rates. The stated rate is the coupon rate. The effective interest rate is the rate, the IRR, when the bond is issued, which we're using for amortization purposes. They'll also talk about any features on the bond, such as call provisions. Remember, a call provision gives the issuer the right to buy the bond back earlier at the call price. And conversion privilege, such as conversion into equity. Any restrictions imposed by the creditors, i.e. covenants, will be detailed. Any assets pledged as security will be detailed. What do we mean, assets pledged as security? Well, of course, if the bond has security, in the event that the issuer defaults on interest and principal payments, then they can be put into liquidation. These assets that have been used as security can be sold off, and the bondholder will get their cash back as a preferential creditor, i.e. above non-secured creditors. Now, again, the final one, a very important one, is the amount of debt maturing in each of the next 5 years. Important for the analyst because then we know what future outflows are likely to be as bond matures, and also requirements for new bonds to be issued. We now turn our attentions to leasing. Our first LOS is discuss the reasons to lease. Now, the alternative to leasing an asset, of course, which is essentially renting in an asset and using it, the alternative to that is borrowing money and purchasing the asset. So why might we lease rather than borrowing cash and buying the asset? Number one, short period of use. We might want to use the asset for substantially less than its useful economic life. Step two, cheaper financing. You might be able to attract a lower interest rate within a lease than you can borrowing externally and purchasing assets. No down payment. We don't have to pay for the entire asset value up front. Instead, we're just going to have to make rental payments under the terms of the lease. Fourth advantage is a fixed rate. If you enter a lease, essentially you're locking into a fixed interest rate over the life of the lease. This might be attractive, especially for companies that can't borrow using fixed rate bonds and therefore are forced to use floating rate notes. They may have fewer covenants, of course, than a bond. Less risk of obsolescence. Well, this is talking about the asset itself. Ultimately, we don't own the underlying asset. So at the end of the period, it returns back to the leasee from the lessor. So it's the lessor's problem that if the asset becomes obsolete, not the leasee. Potential financial reporting advantages. Now, this is to do with operating leases, which is our classic form of off-balance sheet finance. We see no asset, but more significantly, we see no liability for operating leases, even though we've got a commitment to make future payments under the terms of the lease. And the final part is tax advantages. It's possible to own an asset for tax purposes and then therefore deduct depreciation in your tax returns without actually having to report the asset and also therefore the liability for accounting purposes. In other words, you can have certain leases that qualify as operating leases for accounting purposes, but not for tax purposes. So there may be tax advantages. So let's have a little look at finance leases versus capital leases. Finance lease, otherwise known as a capital lease, versus an operating lease. Now, the key point is finance and capital leases are going to have balance sheet recognition, whilst operating leases do not. Now, US GAAP here is far more prescriptive than IFRS. So notice it is a capital lease if the lease meets any of the following criteria. So it's not all, it's any of these. Number one, title of the leased asset transfers to the leasee from the lessor at the end of the lease. Remember, the lessor owns the asset and leases it out. So when the final rental payment is made, then essentially the lessor transfers the ownership of the asset to the leasee. The person who's using the asset becomes the owner. A bargain purchase option exists, so the leasee has the opportunity to buy the asset below its fair value. And 3 and 4, these are the two that get examined all the time, so make sure you know these. Number 3, the lease period is at least 75% of the asset's economic life. And number 4, the present value of the lease payments is greater or equal to 90% of the leased asset's fair value. Any of those, and it is a capital lease or stroke finance lease. IFRS says you treat it as a finance lease if substantially all the rights and risks of ownership are transferred. So if all of the rights and risks of ownership have transferred from the lessor to the leasee, then it is a capital lease. You can see US GAAP is more prescriptive and therefore more likely to be tested in the exam. So let's have a look, therefore, at the treatment. Our LOS says determine the initial recognition and subsequent measurement of leases. So what we're trying to do with a finance or capital lease is to make it look as if we've purchased the asset and we've used debt to do so. In other words, an asset will appear in our plant, property and equipment, and a liability will appear in both current liabilities and long-term liabilities. And of course, the liability will represent the present value of the future payments we're due to make under the terms of the lease. Okay, so notice we look at the lower of fair value or the present value of future lease payments, and the lower figure gives us the balance sheet asset or liability at the start of the lease. Now, I should point out the only time where the balance sheet asset in PP&E has to be equal to the liability is at the start of the lease's life. At the end, during the lease's life, the asset and liability do not have to equal one another. Both have their own separate double entry bookkeeping driving them. In fact, the asset, because it's in PP&E, plant, property and equipment, it's going to be depreciated over the life of the lease. Interest expense is going to be recognized on the liability. So notice we're saying we're going to treat the liability a little bit like amortizing debt, where each payment we make, part of it is paying off the interest and part of it is paying off the principal. Let's have a look at an example. We're going to have to potentially calculate, so we need to be able to do this. Okay, so we've got a firm leasing an asset for 3 years. The payments are going to be $10,000 at the end of each year. We've got straight line depreciation with zero salvage value. The fair market value of the asset is $27,000, and we've got a lease discount rate of 7%. So first of all, we need to work out the present value of those lease payments. So what we're going to do is clear our calculator out and then do n equals 3. So 3 and then n, 10,000 and payment in there, and put in our discount rate. We're told the lease rate is 7, so 7 and IY, and compute present value. Now you notice we get 26,243. This figure is lower than the fair market value, so we're going to use 26,243 as the value of the asset in our balance sheet and also the value of the liability. So notice both the asset and the liability is recorded initially at the present value of the minimum lease payments. Okay, now here's what's going to happen to the liability side over the life of the lease. So notice there originally at the beginning of year 1 is the liability sitting at the present value of the future payments, 26,243. What we can then do is take that beginning value, 26,243, multiply by the rate that we used to calculate it, the 7% discount rate, and we get 1837, which is year 1's interest rate. Now at the end of the first year, because payments are in arrears in this example, remember you could do it by setting if payments were at the beginning of each year, change your calculator to begin mode. But payments at the end of each year. So at the end of the period, we get a payment of $10,000. Now, that $10,000, 1837 is paying off interest, and therefore the remainder, which is, what is that, 8163, is paying off principal. So notice there, therefore, that the value of our liability falls by the principal element, and that is therefore decreasing by 8163. So 26243 minus 8163 gives us a closing value for our liability of 18,080. Year 2, 18,080 is the beginning value. 7% of that gives us 1266, which is our interest expense, and then we've got a payment of 10,000. Again, it's the same logic. 1266 of that payment is interest, and therefore the balancing 8,734 is paying off principal. So you'll notice in year 2, therefore, that the liability value falls by $8,734. Year 3 comes around, and we've got an opening liability now of 9346. 7% of that, 654, payment of 10,000. Okay, so you've got your 10,000 payment. 654 of that, of course, is interest. So the remaining 9346 is paying off the liability. So the liability is dropped to 0 over the assets, over the liability's life, the lease's life. Now again, you should be aware that you can do this on the calculator. If you've got N as 3, IY as 7, and the payments of 10,000, then of course, what you can do, is you compute your present value, as we've got 26,243. Then you can go second function and use the amortize button above the above the present value button, and you'll get P appearing on your screen. So let's say we want year 2, P1 equals 2, beginning of year 2, P2 equals 2, end of year 2. Then when you press your down arrow, you'll see the first thing you get is balance, which is the liability at the end of year 2, beginning of year 3, 9346. Down again, principal, which is 8734. That is the amount of principal paid off in year 2, but we can see that interest was 1266, principal 8734, giving us our 10,000. Down arrow again on the calculator, it gives us the interest payment of 1266. And of course, you can do that for each year. So you can do these leases on the calculator. Again, remember, if you've got a lease where you're making payments immediately, then put your calculator into begin mode before doing the computations. Notice the other element we've got here is the balance sheet value of the asset. Remember, initially that asset was recorded in your PP&E at 26,243. And we're depreciating it straight line over 3 years. So 26,243 divided by 3 gives us our depreciation figure of 8,748 per year. So at the end of year 1, we've got 1 year's depreciation. So 26,243 minus 8,748 gives us our 17,994. In the second year, we've now got 2 years of depreciation. So essentially, the total depreciation is now 17,496. That's the accumulated depreciation. Asset value was originally 26,243. So we've got a net book value at the end of the second period, carrying value for the asset of 8,747. And of course, at the end of the third year, the asset should be fully depreciated. No salvage values involved here because remember, we don't own the asset. It's the lessor that will receive the asset back at the end of the third year. Okay, notice as well that the year-end value of the liability is not equal to the book value of the asset, the book value of the asset. The only times, essentially, where you see the value of the asset and liability equaling one another is right when the lease starts. They'd both be at 26,243. And right when the lease ends, both would be at 0. Only other thing to note here as well is our liability values, we wouldn't see them all sitting in one place. So take that opening 26,243. Now, of course, part of that will be paid off during the first year, so would be sitting in current liabilities. In fact, what we're going to essentially say is 8163 would be in current liabilities, and 18,080, which would be paid off in year 2 and year 3, would be in long-term liabilities. So remember, you have to split the lease liability between current leases and long-term liabilities. Let's have a look at the impact on the cash flow statement. Nothing too gruesome here. All we really need to say is the total cash outflow is equal to the rental payment of $10,000. However, with a finance lease, capital lease, the interest element goes through cash flow from operations, and the principal element, of course, goes through cash flow from financing. Under an operating lease, you should be aware that the full $10,000 would go through cash flow from operations. In fact, with operating leases, remember there's no recognition of an asset, no recognition of a liability. All the double entry is, every time you make a payment, is to reduce cash by that year's rental payment and put the rental payment in the income statement as an expense. Notice, therefore, with operating leases, the full $10,000 would be deducted from cash flow from operations. So, in fact, the one good thing we can say about finance leases is you would get a better CFO figure. In year one on our lease, CFO would be reduced by 1,837 under a finance lease, but a full 10,000 under an operating lease. Now, what is the total impact of a finance lease on the income statement? We need to be a bit careful on this. It's not just the interest element, but it's also depreciation. Now, notice it says net income in the earlier years is likely to be lower for finance leases compared to operating leases, but the reverse is true in later years. Why is the reverse true in later years? Well, what we're going to notice is because the liability gets smaller, the interest payment each period gets smaller. In fact, you can see that clearly on this slide, that it was 1,837 in year one, but only 654 in year three. And therefore, the impact on your net income reduces over the life of a finance lease. Whereas under an operating lease, it's just a smooth 10,000 each year. Again, another key point is the total impact on your income statement will be the same for an operating lease and a finance lease. In other words, a total amount of 30,000 will go through both. Let's see this clearly set out on the next slide. So here you are for our lease. I put the interest expense in for our capital lease, our finance lease, 1,837 for year one, 1,266 for year two, and 654, and the depreciation, 8,748 for each year, to give me the total payments under my capital lease. So the total amount going through the income statement, 10,585 in year one, 10,014 in year two, and 9,401 in year three. So net income will be adversely affected by the finance lease in the earlier years, but it will get bigger over the life of the lease. Notice the total amount that's gone through the income statement over the life of the lease is $30,000, which is exactly the same as the operating lease. But no, more went through in year one, $585 extra went through on a capital lease compared to an operating lease. So your net income was 585 smaller. But notice in year three, then essentially the reverse is true. Less goes through under a capital lease and more under an operating lease. But over the life, the total amount is the same, 30,000. With a capital lease split between interest and depreciation, with an operating lease all treated as a rental expense. So again, notice earlier years, higher expenses, lower years, lower expenses. Why? As the interest element declines, as the liability gets paid off in the balance sheet. Okay, so a quick look at how it impacts on our financial statements. Under a finance lease, we have higher assets because we recognize an asset up front. Under an operating lease, in comparison to a finance lease, it's going to be lower. Remember, no asset recorded. The same is true for liabilities. Under finance lease, we recognize a liability. Under operating leases, we don't, so higher liabilities. As we saw clearly on the previous slide, for a finance lease, you get lower net income in the earlier years and higher net income in the later years. Remember, net income over the total life is the same under both. Now, cash flow from operations, though, is better under a finance lease. Why? Well, because, of course, only interest goes through CFO. Under an operating lease, remember, the full payment goes through CFO. However, cash flow from financing, of course, is going to be lower under a finance lease because the principal payments go through CFF. Whereas under an operating lease, of course, nothing affects CFF. Overall, the total cash flows are the same, the $10,000 that we paid at the end of each period. Right, we've got a little lease problem to have a look at. If Acme reports its lease of equipment as an operating lease rather than a capital lease, the effect in the first year would be 2. Okay, so we're treating it as an operating lease. It would increase net income, true, because net income is lower in the earlier years of a capital lease. So if we treat it as an operating lease, we'd have higher net income. And it would decrease CFO. Now that sounds good to me, because remember the full payment goes through under operating lease through CFO, whereas only interest goes through CFF. Let's just check the other ones. Increase net income and increase CFO. No, of course it would decrease CFO and operating lease. Decrease net income, well, we don't need to go any further. So our answer should be A. Okay, so we've been looking at how to account for a lease from the leasee's point of view. Remember, the leasee is the person who essentially rents the asset and uses it. The leaseor, of course, is the person who owns it. So we're now going to turn our attention to leaseor accounting. Now again, we're going to make the distinction between operating leases and finance leases. With an operating lease, the asset remains in the leaseor's accounts. So it sits in their balance sheet within their plant, property and equipment. And essentially, they're going to treat any payments they receive under the operating lease as rental income in their income statement, and they're going to depreciate the asset as per normal. Now with a finance lease, this is going to be slightly different. Notice the leaseor is going to report a lease receivable on the balance sheet. Okay, so in other words, we're going to have an asset that represents the present value of the future payments that the leasee owes the leaseor. We're going to recognize lease payments as partly interest and partly the return of capital. Fair enough, just the same really as the leaseor did, but they were looking at a liability. The leasee did. The leasee was looking at a liability. The leaseor is looking at an asset. Now here is a little difference. They talk about sales type leases and direct finance leases. Let's take each one in turn. Now with a sales type lease, typically the leaseor is a manufacturer or dealer of the leased equipment. The only difference is, rather than selling the asset for cash, they're leasing it instead. Now, the reason we detect, or the way we detect it's a sale type lease, is that the present value of the lease payments is greater than the carrying value of the leased asset, i.e. the cost of the leased asset sitting in the leaseor's balance sheet. So what that means actually is at inception, the leaseor is going to recognize a profit as if they'd sold the asset for cash. The sales figure will represent the present value of the lease payments. The cost of goods sold figure will equal the carrying value of the asset. That is going to take it out of their balance sheet, out of plant, property and equipment or inventory, depending on how they treated it, and into the income statement within cost of goods sold. Okay, so that's what they're then going to do. They're then going to have a lease receivable sitting in the balance sheet equal to the present value of the lease payments. Now notice the present value of the lease payments is a higher figure than the cost of the asset. Okay, now interest revenue is going to be recognized over the lease term, and we're going to split our cash flows between interest revenue that will go through CFO and payment that reduces the lease receivable, which is going to go through cash flow from investing this time. Now let's look at a direct financing lease. Here, the leaseor is not the manufacturer or dealer of leased equipment. In other words, they're a finance company. What's happening is the leasee is approaching this company and saying, I need this asset within my business. The direct financing company goes out and buys the asset on their behalf and leases it to them. The key point is their motivation, the leaseor's motivation here, is purely as a financing company. They're not a manufacturer or dealer of this equipment. Now, the way we spot a direct financing lease is that the present value of the lease payments equals the carrying value of the leased asset. In other words, there's no profit recognized at the lease inception because the sales equals the present value of the lease payments and the cost equals the present value of the lease payments, giving you zero profit up front. And it makes sense. Look, they're not a seller of this equipment. When we looked at the sales type lease, the key point was the present value of the lease payments was lower than the carrying value of the leased asset, and therefore they recognized a profit up front. So here we have no profit up front. Instead, it's all going to be interest revenue over the life of the lease. Again, interest is going to go through CFO in the cash flow statement, and the principal payments on the lease are going to go through CFI. Now, we've then set out a direct financing lease example. You should be aware that it would be exactly the same for a sales type lease. The only difference would be that the present value of the lease payments would not equal the cost of the asset, so there would be a profit in the income statement straight up front. In terms of the lease receivable that sits in the balance sheet and its treatment, it is exactly the same under direct financing and sales type leases. Okay, so Roland Incorporated leases a machine to Hall Company. The lease qualifies as a finance lease. The terms of the lease are that 3 years at $10,000 per annum. They estimate the machine can be sold in 3 years for $5,000, and the asset costs $24,000. Okay, so all we're going to do is work out the rate implicit in the lease. Essentially, we know that the present value is $24,000. We know N is 3, payment $10,000, future value $5,000, and therefore we can compute the internal rate of return and get 19.897. Now, of course, what this means is the present value of the future payments, the 3 lots of 10,000 and the 5,000, are equal to the cost of the asset, 24,000. What we would expect to see under a sales type lease is the present value of the future payments, i.e. salvage and rental payments, to still equal 24,000, but for the asset's cost to have been less than that. So maybe the asset cost had only been 20,000, so they would have booked a 4,000 profit up front. Now, whether we're looking at a sales type lease or a direct financing lease, the rest is the same. The treatment of the lease side is the same. Initially, we record a liability there at $24,000, and that is, of course, equal to the present value of the lease payments that they're going to be receiving. So 24,000, present value of the cash flows that they're going to receive. That is the same figure no matter what we're looking at. The interest income, well, we're going to take the rate that we computed on the previous slide, 19.897, and apply it to that opening asset. So 24,000 times 0.919897, and we get a value of 4,775. We've then got the receipt of cash at the end of the period, 10,000, from our leaseor. Now we're going to say 4,775 of that, of course, is interest, and the remainder, 5,225, essentially is paying down our asset. So our asset falls by 5,225 to 18,775. Year 2 comes around. Opening asset value, 18,775. The interest income, again, 18,775 times the rate implicit in the lease, 19.897, gives us 3,736. We receive 10,000, 3,736 is interest, the remainder is paying off the asset, so 6,264. So our asset value falls by 6,264 to 12,511. Year 3, opening asset 12,511, interest income at 19.897%, 2,489. Therefore, when we receive the 10,000, 2,489 is interest, 7,511 is paying off, of course, or is paying down the asset. So our asset now drops by 7,511. So you'll notice at the end of the asset's life, we end up with 5,000 sitting in the balance sheet. Now that asset of 5,000, of course, is equal to the scrap proceeds of the asset. So if the asset is actually scrapped for 5,000, there'll be no impact on the income statement at the end of the asset, at the end of the lease's life. If it's scrapped for more than 5,000, then essentially we're going to get a gain. Less than 5,000, we're going to get a loss in our income statement. Note as well, the interest income is going through CFO. The essential principal payments that we're receiving from the leasee are going through CFI. Okay, on to lease disclosures. So we're asked to compare lease disclosures, operating and financing lease, and be aware of them. So first of all, a general description of the lease arrangement. What type of lease is it? Is it finance lease? Is it operating lease? And of course, if you're looking from a leaseor's point of view, then it will also be, is it a sales type lease or is it a direct financing lease? So we'll also set out the nature, timing and payments to be paid or received over the next 5 years, split every year for those next 5 years, and then aggregate payments beyond 5 years. The lease revenue and expense for each period will be reported in the income statement. Amounts receivable and unearned revenues from leases will be reported, and restrictions imposed by lease arrangements. So if there's any restrictions, i.e. covenants, placed on the company. Right, a little lease problem then. Under IFRS, a leaseor would be most likely to recognise depreciation expense related to a leased asset for a lease classified as. Okay, we're looking at a leaseor here, not a leasee. Okay, now the only time the asset remains in the leaseor's accounts is if it is a operating lease. If it is a finance lease, remember the asset is removed. Under a direct financing lease, the asset's removed but there's no gain or loss on the income statement. Under a sales type lease, the asset's removed and a gain or loss is reported in the income statement as if the asset had been sold. So given that we're looking at a leaseor, they're only going to see depreciation on the asset if it's treated as an operating lease, because that's the only time an asset remains within their plant, property and equipment. Excellent. Right, our next little reading is describe the treatment of pensions, and we talk about defined contribution plans and defined benefit plans. Defined contribution plans are going to be a piece of cake. Defined benefit plans are really a bit of a headache. Now you'll be glad to know that all we need is a bit of an overview here. We don't really see the detail of pension accounting until we hit the level 2 syllabus. So let's start off with defined contribution plans. Here the employer is just agreeing to contribute a specific element, a specific, normally percentage of your salary into your pension plan each period. Now what that buys you when you retire, quite frankly, is your problem. So it's the employee's problem. There's no guarantee from the employer about future benefits. All they're doing is agreeing to, let's say, contribute 10% of your salary into a plan for each year that you work. So the key is the employee has all of the investment risk. Now with a defined benefit plan, it's totally different. Here, the employer is promising you specific payments beginning when you retire. Now these payments tend to be based on certain things such as how many years you've worked up until retirement, what your final salary is near retirement. Given they're making firm commitments to make payments to you based on length of service and final salary, it's the employer that has all of the investment risk. Why do they have the investment risk? Because they need a pool of assets sufficient to generate these cash flows that they've guaranteed to you on your retirement. So here we tend to set up our pension as a separate legal entity to manage the plan assets to ensure that it can meet those contributions or meet those payments, if you like, to the employees on their retirement. Now, of course, we're in financial statement analysis, so it's the accounting that we're interested in. We need to compare the presentation and disclosure of defined contribution and defined benefit. Now, defined contribution, the accounting is a piece of cake, no problems with it at all. What goes through the income statement in the pension expense is simply that year's employer's contribution. So if they've agreed to pay 10% of your pension into your salary into your plan, then 10% will go through their income statement. In the balance sheet, well, typically we shouldn't see any asset or liability because they're not making an obligation to make payments to you based on your retirement. So we shouldn't see any asset or liability. The only time we might see a liability is if they were due to make the contribution into your plan but hadn't done so at the year end. Now let's turn our attention to defined benefit. This is where things get a little bit more complicated. Okay, now what's going to appear in the balance sheet? We're going to see in the balance sheet something called funded status. Now, the funded status is the difference between the fair value of the plan assets and the present value of the payments that will be made to the retirees on their retirement. So we estimate the payments that we'll make on their retirement and discount them back to today's date. That is the estimated obligation. So if the assets are below the estimated obligation, overall, we have a net pension liability. We call it an underfunded pension. If the fair value of plan assets is greater than the estimated obligation, then funded status is positive and we have a pension asset that we report in our balance sheet. Notice, though, the firm must estimate the present value of pension obligations. So, in other words, given that most pensions are based on your final salary, we need to estimate employees' final salaries, their turnover, employee turnover, so we know whether they're going to be working, how long they're going to be working for us, how long until they retire, their mortality rates, how many payments are we going to need to make to them after they retire, and a discount rate. So remember, the defined benefit, the payments you receive on retirement are typically linked to how many years you've worked and your final salary. We can then estimate those future cash flow payments, discount them back to today's date to get the estimated obligation. And it's called a PBO under US GAAP, the projected benefit obligation, and a PVDBO under IFRS, the present value of the defined benefit obligation. Okay, so let's have a look as well about what we're likely to see. Notice the change in the pension asset or liability during the year needs to be reported. We're going to talk about certain elements such as service cost. Now, the service cost is the present value of the additional benefits earned during the year. In other words, for each year that your employees work, they're entitled to bigger benefits on retirement because their service history is increased by 1 year, and therefore the liability value will increase by that year's service cost. Past service costs, which are also sometimes referred to as prior service costs. These are retroactive benefits, or essentially costs, awarded when the plan is typically changed. Imagine we change our plan to paying out 2/3 of your final salary from only 50% of your final salary. So when we make that change to 2/3, we're committing to make bigger payments to you, and therefore the estimated obligation is going to increase. Net interest expense or income typically, therefore, is the beginning value times our assumed discount rate. So in other words, it's the liability value, the estimated obligation, times the interest rate. Now, what we're really simply saying here is for each period, the estimated obligation, the PBO, is going to increase. Because remember, we work out the benefits we're going to pay to our retirees at their retirement date and then discount them back to the current point in time. So for every year that we pass through, we're 1 year closer to retirement, and therefore the present value of those benefits paid is going to be bigger. So therefore the estimated obligation gets larger by the interest expense each period. Actuarial gains and losses. Well, these are changes, if you like, in the pension asset or liability due to changes in the actuarial assumptions. What do actuaries make assumptions about? How long the employees are going to live for post-retirement. They make assumptions about the discount rate that should be used. They make assumptions about the final salary. So if the actuaries change their assumptions, it affects essentially the liability measure, the estimated obligation. Also, there's another actuarial gain or loss that affects the plan asset side of the fair value of plan assets. And that's the difference between expected return on assets and the actual return on assets. So notice the return on plan assets. The actual return on plan assets affects the pension asset or liability. It affects essentially the plan asset side. Okay, pension expense or other comprehensive income. We've got different treatments under IFRS and US GAAP. If you've got actuarial gains and losses under US GAAP, initially they go into other comprehensive income, and then slowly they get amortized through the income statement. If you've got actuarial gains and losses under IFRS, they go into other comprehensive income, but they are not going to be amortized. Now again, remember this is very tricky to understand at the moment because we haven't really seen the full picture, and we won't until we get to the level 2 syllabus. But we've got a kind of overview coming up. So essentially, here's our overview in rather tiny writing, and I wish I'd now brought my glasses so I could read it. So let's have a look at the change in the net pension asset or liability under IFRS and US GAAP. So notice essentially the asset or liability will change by the service cost and past service cost. This year's service cost is the increase in the liability side of the plan, the estimated obligation, because your employees have worked one extra year. Past service costs, remember, are as a result of changing the conditions of the plan. Rather than paying out 50% of your final salary, I'm now going to pay out 60%, let's say. And therefore, in that case, the estimated obligation would increase. Notice, both with service costs and past service costs, they will both affect the income statement under IFRS. Now, interest we're going to see affecting essentially the liability side as well, the estimated obligation. Because remember, the estimated obligation is the present value of future payments. So for every year we work, we're 1 year closer to retirement, so the present value goes up, and therefore the estimated obligation rises. The other side of that, we'll see, is in the income statement. So the interest cost will pass through the income statement as well under IFRS. Now, our remeasurements, otherwise known as our actuarial gains and losses. So actuarial gains and losses, as the actuaries change their assumptions, final salary increase, discount rate to use, life expectancy, and the difference between actual return and expected return on the plan assets, under IFRS, these will not affect the income statement. Instead, they're going to be taken to other comprehensive income, and they will not be amortized. They will never pass through the income statement. Let's turn our attention now to US GAAP. Notice that service cost will go through the income statement. Interest will go through the income statement just like it did under IFRS. Notice as well, expected return on plan assets goes through the income statement. But notice our past service costs and the actuarial gains and losses, they go to other comprehensive income. Now, the big difference is past service costs under IFRS, if you make a past service cost adjustment, it immediately hits the income statement. Whereas under US GAAP, it's going into other comprehensive income. It's then going to be amortized over the remaining service life of your employees. The other big difference is the plan remeasurements under IFRS, they went into other comprehensive income and were not amortized, whereas under US GAAP, they go into other comprehensive income and they are amortized. And remember, if they are amortized, they're going to affect the pension expense over the remaining service life of the employees, i.e. they will hit the income statement. Notice as well, with defined benefit plan reporting, a manufacturing company will allocate its pension expense both to inventory or cost of goods sold for employees that are directly related to the production process. For any employees that are not related to the production process, then it's going to be included in your sales, general and admin expenses. And again, pension details are going to be disclosed in the financial statements. Good, so that's pensions done for level 1. We'll come back at level 2 and really give you the full picture. It was really just an overview in the level 1 syllabus. Okay, I think really you need to pick up on funded statuses reported in the balance sheet for defined benefit under both International Accounting Standards and US GAAP. Prior service costs are immediately expensed under IFRS but not under US GAAP. Actuarial gains and losses under both go into other comprehensive income, i.e. stockholders' equity. Under IFRS, they're not amortized. Under US GAAP, they are. So into solvency, calculate, interpret a few ratios. We've got some leverage ratios. We've got some coverage ratios. Okay, and we should have seen all of these ratios before, so no big shocks here. So let's start off with our leverage ratio. The total debt ratio otherwise known as the debt to asset ratio, is total debt over total assets. Remember our definition of total debt. It's all interest-bearing It's all long-term liabilities and any interest-bearing current liabilities. So all of your long-term liabilities, interest-bearing or not. Your debt to capital ratio is total debt over total debt plus stockholders' equity. And remember, when we look at stockholders' equity, we're talking about the common stock, additional paid-in capital, preferred stock, retained earnings, and all of those other comprehensive income items. Interest coverage looks at how comfortably you're meeting interest payments and is often used in debt covenants. EBIT over interest payment, of course. Remember, with capitalized interest, often they'll reverse the interest back out of the balance sheet and into the income statement on assets in the course of construction before calculating this ratio. Fixed charge coverage does a very similar thing, but includes leases as well. Now, of course, for operating leases, they've been deducted in arriving at EBIT, so we're going to add them back on our numerator, and then we're going to do interest plus the operating rental payments on the denominator.